Picture this for a second. Imagine an invisible dial sitting in some boardroom, and this dial effectively controls the cost of every single dollar you borrow. Whether you're swiping a credit card, expanding your small business, or buying that dream home, the numbers on that dial dictate your financial reality. Right now, that dial is sitting at exactly 3.62%.
Kind of makes you wonder, doesn't it? Who actually decides what your money costs? We so often just accept the interest rates we're handed by our local banks or mortgage brokers like they just fell from the sky. But they don't. There are these incredibly powerful, highly structured forces operating entirely behind the scenes of your daily finances, and they're calculating these figures down to the exact basis point.
Welcome to This Explainer. Today, we're going to decode a highly specific, data-packed document that dictates those very forces. It's called the Federal Reserve's H-15 release. We're going to take this document, which is fundamentally meant for economists and bankers, and we are going to completely demystify it using a clean, real estate-inspired lens so you can actually understand the true cost of money. We're basically going to act as data detectives today.
Okay, let's dive right into this macro to micro roadmap. We'll start by decoding the H-15 release itself. Second, we'll look at the foundation, Fed funds. Third, Main Street's benchmark. Fourth, treasuries and mortgages. And finally, what all this means for you. We're going to translate these dry percentages into a really clear, logical journey.
All right, Section 1, Decoding the H-15 release. Let's start by establishing what this daily snapshot from the Board of Governors of the Federal Reserve actually looks like in the real world. The H-15 Selected Interest Rates is a publication showing yields and borrowing costs across various financial instruments, and it's posted daily, Monday through Friday, precisely at 4:15 p.m., assuming it's not a holiday. Now, at first glance, yeah, it looks like a thoroughly boring government spreadsheet filled with endless rows of numbers and dates. But actually, this is the structural foundation of the entire U.S. economy. It's the raw data feed that dictates literally trillions of dollars globally. And trust me, every major financial institution is watching it closely. Now, what's really interesting about this raw data is how we can just act as detectives and extract only the clues that matter. Taking a quick look at a simplified excerpt from the May 26th release, we can see a few days of Treasury bills. You'll notice how the rates shift slightly day by day, reacting to the market. We aren't going to get bogged down in every single column today, though. Instead, we're just pulling out the specific metrics that actually dictate your financial life.
Section 2, the foundation, Fed funds.
So we're moving to the absolute base layer of our macro to micro story, really focusing on the ultimate source of borrowing costs. Remember that number from the very beginning, 3.62%? Well, this is the effective federal funds rate, and it's highlighted right at the top of that May 26th release. It held remarkably steady at 3.62% from May 19th all the way through May 25th. You can honestly think of this specific percentage as the true heartbeat of the American financial system. Basically, everything else we discussed today gets its pulse from this exact number.
But what is it, really? Well, according to the data we're looking at, the Fed funds rate is essentially the wholesale cost of money. It's the volume-weighted median rate that depository institutions, banks, charge each other for overnight loans. To use our real estate analogy, everyday people like you and me, we never get to pay this wholesale rate. This is the highly exclusive bottom dollar price that banks pay each other just to maintain their required reserves, and honestly, keep their own lights on.
Which brings us to Section 3, Main Street's benchmark, the prime rate.
Let's see how this builds as we transition from the bank's secret wholesale rate to the number that actually hits consumers and business owners, and that number is 6.75%. Just let that noticeable jump from 3.62% sink in for a second. This is the bank prime loan rate recorded in the H-15 release. We have suddenly gone from a rate in the threes to a rate approaching 7. When we put them side by side, the mechanics of the banking industry become incredibly clear. You've got your wholesale cost of money, the Fed funds rate down at 3.62%, versus your retail cost of money, the bank prime loan at 6.75%. That difference, that spread between the two numbers, is essentially the retail markup. It is exactly what the majority of the top 25 insured U.S. commercial banks charge to make a profit when they lend money out to the public. And if you're wondering how this affects you directly, well, we can look right at the footnotes of the H.15 release itself. Footnote number 7 explicitly states, quote, "Prime is one of several base rates used by banks to price short-term business loans." So if you're a small business owner taking out a line of credit, or if you just carry a balance on a standard consumer credit card, this 6.75% is the benchmark that is actively driving your borrowing costs.
When the Fed moves their wholesale rate, you better believe the banks move this retail prime rate right along with it.
Section 4. Treasuries, yields, and mortgages. Okay, so that covers short-term borrowing. But what about the long game? Let's shift the narrative slightly and move from short-term debt to the long-term debt that is absolutely crucial for big life purchases, particularly real estate. If you dig into the H15 release, you'll see a massive section dedicated to Treasury constant maturities. I know, that sounds like intense financial jargon, but let's demystify it so you have the upper hand here. The government basically draws a line to estimate the exact cost of money for a neat, clean 1-year or 10-year period, even if an actively traded bond doesn't have exactly that amount of time left on it. It just gives us a standardized way to measure long-term debt.
Looking at the May 22nd data, we see an upward sloping yield curve. The 1-year Treasury sits at 3.86%, but the 10-year jumps up to 4.56% and the 30-year reaches 5.07%. This brilliantly illustrates a core rule of finance. Locking up your money for a longer time typically demands a higher return just to compensate for all the unknown risks of the future.
And here is the absolute ultimate secret for prospective homebuyers. You might assume your 30-year fixed mortgage rate is based on the 30-year Treasury, right? Actually, it's not. The 10-year Treasury, sitting here at 4.56%, is the crucial benchmark that mortgage lenders look straight at to decide what rate to offer you on a house. Because most people refinance or move well before 30 years are up, that 10-year Treasury acts as the most accurate baseline for housing debt.
Finally, Section 5. What this means for you.
We have covered a lot of heavy, structural financial data today, so let's bring it all back down to earth and trace the complete life cycle of a borrowed dollar in 3 simple steps. This fulfills our whole macro to micro promise. Step 1. The Fed sets the absolute wholesale floor for overnight bank lending at 3.62%. Step 2. Banks mark up that cost to create the retail prime rate at 6.75% for short-term consumer and business loans. And Step 3. The broader market sets long-term government treasury yields like the 10-year at 4.56%, which then directly influences your ability to secure a long-term mortgage.
So the crucial point is this. You now have a personalized cheat sheet for your own financial life. If you want to understand the baseline health of the economy, you watch that Fed funds rate at 3.62%. If you're managing small business loans or dealing with credit card debt, you keep your eyes glued to the prime rate at 6.75%. And if you're in the market to buy a home or refinance, the 10-year Treasury at 4.56% is the exact number that dictates your purchasing power.
You no longer have to view interest rates as these mysterious figures assigned to you by a bank. You know exactly where they come from now. So I'm going to leave you with this. Tomorrow afternoon, when the clock strikes 4:15 p.m. and the Federal Reserve drops the next batch of data, how will those new numbers reshape your borrowing power? Thank you so much for joining me on this explainer. Keep learning, and I'll catch you on the next one.